In this video, we'll be talking about how to raise finance for your business acquisitions. And we'll be talking about particularly how to raise money from investors in this video. There'll be other videos on how to raise money from lenders. When you're going out to do business acquisitions, there's a few places in which you can get money to fund your deals. So let's go through those first. And investors are just one of those. Number one is, of course, you can raise money from your personal savings from yourself, right? Now, a lot of people say that no, you shouldn't put your personal savings, and that is true to a certain extent. However, it's always easier when you can deploy some capital from your personal savings. Number two is from your business. Now remember, your business is different to yourself. So your business savings, or more particularly, it's called retained earnings. Okay? So this is money that you've saved up in your business and you're not using it for working capital, and it's just there as shareholder funds. Another name for that is shareholder funds. So it doesn't matter, retained earnings, shareholder funds, business savings, it's all the same thing. Number three is the seller themselves. So the seller who is selling the business, the seller, we call it seller finance, right? Everyone knows it as seller finance. So that's the third place in which you can get money to get your acquisitions completed. Number four is investors. So that's what we're going to be talking about today. We're going to talk about seller finance it's not really called seller finance, it's called rollover. When the sellers are financing your deal from the perspective of being an investor, they become a debt or a loan provider to you when it's true seller finance. And number five is lenders. So people who are going to lend money. When I say people, there's hundreds of institutions out there that provide these lending products, these financial products to go and get your acquisitions completed. So today, we're going to be talking a little about personal savings, because of course when you're using your personal savings to do a deal, then you're technically an investor. Business savings, we'll talk it from the perspective of being an investor. Seller finance, we'll talk about rollover. Investors, we'll talk about investors. Of course, there's two types of investors, which are both, they either are investor in your business or they are lending you money. And the fifth one is lenders. So these are the five places that you can get money to complete a business acquisition when you go out and buy businesses. So that's a little summary there. Let's get into the rest of the video now. The first thing to understand is that there is plenty of money out there to get your deals done. So you will always be able to find money to get deals done. There's plenty of money, right? And it's for the right deals. It has to be for the right deals. Anyone can find a deal, but the deal can be a bad deal, or it can be a good deal, or it can be a fantastic deal. So for fantastic deals, the right deal, there is plenty of money out there. If you said to someone that if you invest £1,000 in this today, then next month you're going to get £2,000, and they can see the actual vehicle of investment, they're going to put the money in, because they're going to double their money in a month, right? So for the right deal, there's plenty of money out there, whether it's from an investor, whether it's from a lender, whether it's from family, whether it's from friends, whether it's from anyone. For the right deals, there's plenty of money out there. And if anyone tells you anything different, look, we have limiting beliefs ourselves. If you think that you can't raise finance, it's because you've got a limiting belief in your own mind. You need to unlock that limiting belief, and if you go and find the deals and then go and raise finance based on those deals. So that's the first thing to understand. Now, there are the two types of investors out there. The first type of investor is an individual investor. And for the purposes of this video, we're going to say that your personal income and your retained earnings are also from the perspective of an individual investor. But then you've got other individual investors too, like angels. Angels are considered individual investors. Now, if they're sitting in a angel's den, as they're called, just like Dragon's Den or Shark Tank, then they become a little bit more institutionalized. However, they're making their own decisions. So for example, if you ever watch Shark Tank, if you ever watch Dragon's Den, then what you'll see is that you've got 5 individuals sitting there, and they're making their individual decisions with regards to whether they want to invest into that business or not. So they're called individuals as angels. So that's your individuals. The second type of investor is your institutional type investor. Now, we're not saying institutions as a pure institutions like large insurance companies, large pension funds, large family offices, large private equity houses. We're not talking about them. We're talking about smaller family offices. We're talking about small private equity funds. We're talking about like your mum and pup pension fund, which is maybe got like 5 million in there, and they need to allocate some of the capital to make a return on their investment and grow their pension fund. We're talking about that type of institution. But before we get into the institutional investor, or the small institutional investor, we'll call it that, let's start off with individuals. So with individual investors, let's talk about individual investors. Individual investors. With individual investors, it's all about building a relationship with the individual investor. The individual investor is really interested in your story, where you come from, what business you are going into, why you're in that business. So they're really interested in that kind of thing. So the story is really important for an individual investor. And just think about yourself. Like, if, for example, someone came to you and they said, right, we want to raise some finance, let's say it's a small amount of money even, we say, okay, that's fine. Why are you doing this? I know you, you're my cousin or something. That's fine. I know who you are, but why are you doing this deal? Why are you going to this industry? Why is this so important? So now they're going to explain that story to you. The same way, you have to have this story that you've built up and you're going to present to individual investors. Now, stories are important for all types of investors, but it's mostly important for individual investors. And they really want to know that why you're doing this, and they want to see also a good business plan as well, right? Remember, investors, they only ever care about one thing, ROI, return on investment. Yeah, return on investment. Oh, anyone only ever cares about return on investment. Why are you doing your acquisition? It's because you want a return on the investment of your capital or your time. That's the only reason why people get jobs for return on investment. They go out, they spend their time, whatever it is, part-time, full-time, and they go out, they work, and then they get a return on their time investment with a wage packet. So everyone is only ever concerned about return on investment. And then you have to build that in there. So number one, the story, we're going to say, what is the industry? Why this business, this business or industry, and then what's the return on investment? We're just going to use ROI, What's the return on investment? How much money do I need to deploy, and how much do you want from me as well? How much capital? These are the things which are really important to individuals. Like, right, no problem at all. That's fine. I understand your story, I understand your background, I understand what is the industry, and I understand why this business and this industry, let's say industry and business. We're going to talk about business or industry in a minute. So why this industry? And then what's the return on investment and how much capital? So that's in a nutshell what they want. Now there's a build up to this. There's a build up on how you're going to pitch these investors. So first you're going to tell them the story, and then you're going to tell them the industry. And by the way, individual investors, if they've got a significant amount of capital, let's say for example, I reckon this is important for people who have at least $500,000 plus to deploy into investments. If they've got $500,000, maybe $250,000 actually, $250,000 plus to deploy into investments. They want to know, or they want to have a connection with that industry too. So for example, if anyone came to me and they said, do you want to invest in the gambling industry? Or in fact, this happened to me. Someone came up to me and they said, do you want to invest in the vaping industry? I said no, because I don't want to be involved and associated with the vaping industry. I don't want to be involved and associated with the gambling industry. And for religious reasons, I won't do gambling. But vaping is actually quite permissible, but it's maybe not the best way that I want to go out and raise money. So it doesn't meet up with my own beliefs. The same way, when you go up to an investor, they want to see is that, do they have a connection with this industry? Are they happy to deploy capital in this industry? And if word gets out that they're an investor, then would they be happy to have their name attached to this particular business? So that's why what the industry is very important to certain people. Why this industry? Why this industry over all other industries as well? That's fine. I understand this industry is good. I understand, or I'm happy with this industry. Why is this industry good for an investment? So for example, there may be 10 industries that someone is like, okay, I have no problem with the industry, but why is this industry so special that you're going into it and you're asking me to deploy capital? So you need to build up this story. There's also two types of fundraising that we need to get to now as well, and that's investing for the overall business, or you want to call it fund. So are you raising money for the total fund? Let's just get rid of this here. So are you raising for the fund, which means the entire project, or are you raising for a particular business / investment? So what's the difference? When you're raising for the fund, what you're saying is that that's fine. I want to go out and look at this entire industry, and I want to do, for example, 10 deals. I want to do 10 deals in this industry. So when you're raising for the fund, what you're asking the person to invest in is all 10 deals or some allocation to the 10 deals. It doesn't matter when you do those deals. It doesn't matter the size of the deals. It doesn't matter about the individual deals. It's all of the deals together. That's what you're asking to invest in. So it's the thesis, it's the idea, it's the project in as a total. So for example, if you're going to say that this 10 deals we're going to do over 3 years, you're asking them to commit capital for 3 years. You're asking them to commit capital for all 10 deals. You're asking them to commit capital to the entire project. If you're doing it particular for the business or the investment, it's also known as syndication, by the way. So syndication. The reason why it's known as that is because what you're doing is that you're syndicating money from multiple people for one particular deal. So the particular business, the particular investment, the particular syndication. So, all right, I have this one particular deal, and this one particular deal is going to give an ROI of, for argument's sake, 30%. And I need you to do 500k for this particular deal. So a fund is, I want you to put in a total of 2 million for the entire project. This particular business, you can say, right, I want 500k and I'm going to get 30%. With a fund also, you have to give target projections of what you want to return to the investors, because investors, you don't even know, in fact, what the total return on investment is going to be. When you have a particular deal that you're going out to raise money for, you know the numbers because you see the deal, you've negotiated a price, you see what the earnings are of that business, then you're able to do the math and come up with some level of predictable mathematics for that particular deal. But when you're raising for the fund, you can only target returns, you can only target return on investment. So it's slightly different. People are happy, by the way, to put money into funds. There's plenty of people who put lots and lots of money into funds. I will say is that when you're starting out, you want to it's easier to raise finance for particular individual investments in individual businesses. Because what you're saying is that, here, I have this thing in my hand right now, we've negotiated this price, this is how much we need, and this is the potential return on investment over this period of time. So it's very easy for the person to understand exactly what they're getting when they're investing in that particular deal. And also, I will say is that individual investors are happier to invest in individual investments. They're happier to invest in individual investments. In fact, I was speaking to one of my friends the other day who's an investor, and he says he only ever invests in particular deals. He doesn't like going into particular funds. It's because he's done it once before and it wasn't quite what he expected, because there were targets that were given with regards to return on investment, how long his capital is going to be tied up for, and one of those targets were missed, and therefore he was upset. Right? He wasn't happy about it. So that's why, individual investments for individual investors is really important. And you, as a person, you'll be able to say, okay, this particular deal, I know exactly what I'm going to get or what I'm targeted to get for this particular deal. If I put, for example, 30,000 of my own money into that, 50,000 of my own money into that, or 150,000 of my own money into that, I know that over 2 years I can get my money back, for argument's sake. So that's you. The benefit of deploying capital from your shareholder funds or your retained earnings from your business is that you're investing in another business and you're not drawing a dividend. So therefore it's not a taxable event at that time. When you give money from your business to another business venture, then that's an investment. Then it's going to get a return on investment. It's not a taxable event, and that's the best thing, because of course money is lost to taxation. Half of money also almost is lost to taxation. So from a retained earnings perspective, this is the best way to use the retained earnings to put it into investments, and that's particularly in this case business acquisitions. Now, there's also two ways of raising money from both individuals and institutions. In fact, this is applicable to both. So this is applicable to both. So this is for family offices as well. I'm just going to use family offices when we're talking about institutions. They can either give you money from a lending perspective, or they can be direct investors. So they can say, right, I will give you money, but this is a loan. This is a loan, and either it's interest free or has interest. Normally when you're going to get money from family offices and investors, why would they give you any money from a lending perspective without attracting an interest rate? Most people are going to give you that from an interest rate perspective. And direct investors, they're not going to take an interest rate from you. They're going to get equity in the business. So they're going to get equity in the business. And how much equity is all down to negotiation, right? So it's funny because I remember when I was first starting out, someone said to me that they're going to give me, I think it was 70k, but no, they were going to give me 30k, but they wanted 70% equity. Well, I didn't do the deal, right? So that's ridiculous. So they were going to give me 30k for 70% equity. And the 30k, by the way, was like a very minute part of the deal. And the 70k was, the 70% would just been like a fantastic return. Now, obviously, I didn't go for it. They're called sharks, as in, like loan sharks kind of people. This is investor sharks. And I'm talking about sharks like Shark Tank. I'm talking about bad sharks. So, yeah, you really need to be careful about how much equity you're willing to give up for this direct investment. So these are the two perspectives of raising money from individuals, investors, and family offices. Now, how many times do you have to meet these people? Look, whether it's from individuals or it's from family offices, you're not going to raise finance on the first meeting. Yes? You can't meet someone for the first time and tell them to give you £1 million. It's never going to work. Normally, on average, I see you need about 4 to 6 meetings to get capital. And this is whether it's your family or not, right? Of course, if you're getting money from your family, then it's going to be on the lower end. If you're getting money from, individual investors, then it's also going to be, 4 to 6 meetings. And sometimes, family offices, institutional investors, one thing I do find is really important to understand, individual investors, they're playing that story, a little bit more emotion, relationship building. With family offices, by the way, these are the numbers, this is the return. It's not difficult. Actually, I prefer raising finances from these bigger investors, and bigger investors are going to be like that, and also family offices, because when you go there, you say, right, this is what you need to deploy. Okay, so let's say, for example, you need to deploy 5 million, and this is the return. And they literally put into their, does it fit into their criteria? This is a really important thing as well. Each investor has a sweet spot. They have a sweet spot. So you can say, how much do you normally deploy into a fund or into deals? And they're going to tell you, we deploy, for example, 250k to 750k. So you know that if you need at least 250k, you can go to them. Some people might say our minimum is 1 million. Some people say our minimum is 5. It all depends on how much money that they have to allocate or they have to invest. Look, if for example you go to a family office and the total value of that family office is 100 million, there's no point them giving anyone 250k. Because it's not going to move the needle on their investment, on their return, and on their investment strategy, on their thesis. They're going to have to deploy, look, if you've got 100 million, investing 1 million is 1% of your fund. It's actually difficult. You'd rather deploy larger amounts of money. So for example, someone's asked for 5 million from a 100 million family office, then it's going to be like, okay, you know what, I'm going to allocate 5% of my fund to this and let's see where it goes. It makes more sense. So it's really important. You ask for them for the sweet spot. I call it the sweet spot. Yeah, it's called the ideal deal size. And so it's really important that you, by the way, you ask this very quickly. What's their sweet spot? Look, if you go to a individual investor and say, I need 5 million, and they've only got 500,000, they can't give you 5 million because they only got 500,000, and they're not going to give you 500,000. They're not going to give you 100% of their money. They're going to say, right, I'll give you, I don't know, 50 grand, or I'll give you 100,000, for example. So you need to find their sweet spot. I always actually, I have this, I go there, I say, right, do you like the industry? These are the 3 questions. Do you like the industry? That's question number 1. And what is your deal size? Ideal deal size. These are the 2 questions that I ask first. Then ask, what kind of return on investment do you want? So what kind of ROI are you looking for? And then when you ask these 3 questions, you will quickly be able to determine whether you can deliver the ROI they want, whether you're in the industry that they like, and for example, whether you are raising enough capital for them, or are you raising too much? Yeah, are you raising too much? So if you go to these sort of smaller investors, they're not going to be able to put money into deals. Like for example, for us, really and truly now, we're not looking for investors of less than 250,000. If you're less than 250,000, you have to bring something else to the table. So if someone came to us and said, right, we'll give you 100,000, be like, okay, that's fine, but what else can you bring to the table? Because 100 grand isn't going to move the needle for us anymore, right? Someone, in fact, there's 2 people that spoke to me this year, and I had the exact same, they had the same question and the same answer. They were investors and say, right, that's fine, we like, in fact 3 people, say we like your business and we like what you're doing, and I want to invest some money. I said, no problem, how much have you got to invest? And they said like 5, 10, 15 grand, one of them. The other one said it was like 70 grand or something like that. I said, look, really and truly, and I told them straight, but when I say minimum 250,000, I said to them, if you haven't got 1 million to invest, then I can't help you. Because we need about 500,000 to 1 million to be able to do the deals that we are doing right now. Minimum. Yes, minimum. So if someone comes along and says, right, we've got 2 million, we're open book. It's all right, that's fine. Let's have a conversation. Let's have meetings. Like for example, next month I've got meetings with people who they invest between 750,000 to 7.5 million. So that is going to do something for us now. Yes. If for example they turned around and said that we can only do 75,000 to, I don't know, 125,000, it's not really going to help us because we can't do anything with that kind of money anymore. So that's why you find out their sweet spot and also the ROI that they want, because it's all about return on investment. Now, when you're going out to do acquisitions, you should be targeting at least a 20% ROI, minimum. Minimum 20% ROI. That's what you want to give to these people, because it's an alternative investment. It's risky. When you're going out to do an acquisition, it's much riskier than putting your money into the S&P 500 or the FTSE 100 or the FTSE 250. It's safer to put your money in there. That's not 100% safe. Nothing's 100% safe. Even if people think that properties are safe, and of course properties are safe, but what about if there's an earthquake and all of a sudden the property falls down? Or there's a fire? And I know there's insurance that covers that, but that's besides the point. What I'm saying is that nothing is without risk, but acquisitions is riskier. So that's why you need to target a higher ROI. And by, even though we target anything, minimum 20%, the lowest that we've ever returned is 33%. So we've got that kind of track record, and we go to investors and say, right, we're going to give you, we target 20%, but we've always achieved 33% or 30%, then they're interested. They're like, okay, you know what, I can get my money back in 3 years. There is a lock-in period, and that's also what you want to do, in fact. For when you're raising money from individuals, or whether you're raising money for acquisitions, forget whether it's individuals or family offices. When you're raising money for business acquisitions, you want to have a lock-in period. So we have a minimum lock-in period of 5 years. That's what we're currently locking in for. Very rarely do we have a lock-in period of 2 years. Yeah, but that's only like for 1 or 2 people we done that. But 5-year lock-in period. Which means that they can't take their money out for at least 5 years. They can't, so if they invested, for example, 250,000, they can't say to us, we need 250,000 back before 5 years. Now we may distribute dividends to them, and we do that, by the way. We distribute returns to all of our investors during the lifetime, not straight away, and you have to be upfront. You say, look, for the first 2 years, you're going to get nothing. Yeah? For the first 2 years, there's no return. But then after 2 years, you're going to start getting for example, quarterly or half yearly is better actually, a half yearly dividend, right? You're going to get a half yearly payment, some sort of return on your investment. And then from 5 years, that's when you can start asking for your money back. And by the way, what we've had is that we've had some people who have said, we don't want our money back. We just want you to keep it in there and continue to give us this return. And in fact, they want to give us more money. But the thing is that has to be the right amount, and that's fine. You know, as you get bigger, you can't do smaller capital raises anymore. Someone who comes in at £10,000 or 15,000 or 25,000 pounds, they're not going to do nothing for you. So that's really important. Now, coming to family offices and other institutions like that, they want your story, and they have to already like your industry. Like your industry. And they want to know the capital, how much capital amount, yeah, to be raised. And they want to know ROI. Yeah, or potential targeted ROI if you're raising for the fund. And also what you need to research a little bit more about the family office. You say, do they actually invest in the industry? And also, how much do they normally deploy? So we've gone to institutions before, and we've asked for money, and it's not been enough. So I remember we went to an institution, and we said we wanted, I can't remember what the exact number was. I think it was something like 1.5 million or something. I can't remember. I think it was, let's just say it was 1.5 million. We wanted 1.5 million, and they said, no, we don't do anything less than 2. So come back when you want 2 million. And that's one deal, by the way, right? So they said we can only do 2 million per deal, because we know that those kinds of deals are the ones that can give you a return. So they want to know the story, they like your industry, the capital amount, and the ROI. Now, the other thing is that if you can prepare a pitch deck for them, that's good. A pitch deck. They want to know your mission, why you're doing it. They want to know what your mission is or what your vision is. Okay? They want to know the exit. Right? They want to know the long-term plan. Is there an exit, or are you just holding forever? Right? They want to know where's the exit. And they want to know where the exit is for them. Exit for them. This is really important. They can say, okay, that's fine. We will give you, for example, 5 million, or we will give you 3 million, or we'll give you 1 million. But when are we going to get 100% of our money back and our return? When is that going to be? When? Put that here. When is the return? And if you can prepare that into a pitch deck, and ideally a summary, so like a letter, like a memo. So this is also very important in family offices, is that they have multiple layers of authorization. So normally you meet with a partner, and the partner, you will give them like a summary, you give them the pitch deck, the mission, vision, exit for them, the ROI, the capital amount, you give them all of that, right? And they normally put it into like a memo or a letter, and it goes to a committee. Let's get rid of this. No, I'll keep it here. It goes to a committee. And the committee, oh, that's not how you spell committee. That's fine. It goes to a committee, and the committee decides whether they're going to give the investment or not. So you're not going to, and that's why it takes longer. Remember I said 4 to 6 meetings previously? Normally it takes about 6 meetings, and then you have to wait. Now, depending on the family office, it can either take a long time for it to go to partner, to memo and letter, and then the committee, or it can take very quickly. So, for example, we deal with this one investor who, institutional investor. They have a turnaround of 7 days, 5 working days basically, so 7 days, and they will tell us whether they are interested of giving us money or not. And also, you might talk to the partner for, a month. And by the way, I have a video on this channel, on my YouTube channel, which is, I think it's like 5 steps of raising finance. Go and watch that, because that's really important. That ties that in there. I'll give a quick summary of that, but this might take a month. Then they have to prepare the letter or the memo. That may take, it normally takes a couple of days, but let's put 1 week. Yeah. And then the committee decides. That can take, and like I've said, some 5 working days, 7 days, some have, 2 weeks, some have 3 months, right? So you really need to ask the partner up front, how long is it going to take for the committee to give you a decision? When can you give the submission? When can you submit the memo to the committee? What's the kind of turnaround time? Then you can start planning what you want to do. The other thing you want to do is you want to always go to multiple investors, because normally you need to syndicate the money. You need to have 3 to 5 investors per acquisition. And the best way we do this is that we just put it into a limited company. So it goes into a limited company, and these 3 to 5 investors are shareholders into the limited company, and then we deploy the capital like that. So let's go into the 5 steps of raising finance, which I have a more detailed one on another channel, on another video on this channel. But let's talk about it here. So the 5 steps of raising finance is, number 1, outreach. So you have to find these people. You have to find these people. You're always doing this. You're going on LinkedIn, you're going on Google, you may have working with network partners, suppliers, friends, family. You'll be surprised how much money your friends and family have, and then the contacts of your friends and family. Look, once you do a good deal with someone and you return a good amount of capital or investment to them, then they go and talk about it to their friends, and their friends are like, I want to get involved. That's why, for example, the people that come to me now, or the ones that came to me in the year, those 3 that I couldn't, actually I said no, they were all people who knew other people who had invested money, and they also wanted to invest money, and I said no, because it was just too less. But anyway, so you're doing outreach all the time, partners, LinkedIn, social, everything. Number 2, you need to follow up with these people. So I said earlier in this video that next month we have a meeting with someone who invests between 750 to 7.5 million. I first spoke to that person. I did the outreach with that, when I say person, with that institution. It was about a year ago, maybe a year ago. Let's just call it a year ago. Yeah, so I did an outreach 1 year ago, and I followed up with them continuously. So you want to follow up once you make the outreach and the initial engagement with these people, you want to follow up every 3 to 6 months if you don't have a deal for them. And then, of course, when you have the deal, then you want to make the pitch. When you have the deal, you want to make the pitch. And then number 4 is when you have the heads of terms and the ROI, you keep in contact with them. You just keep them updated with the deal. And then number 5 is the capital call. So that's when you actually get the money to draw down. And the money goes directly to the solicitors, into escrow. So it goes directly to the solicitors, to the lawyers. Don't scam people and tell them to put it into your bank account. That's the wrong thing to do. Especially institutional investors, and also angel investors and people who have high net worth, for example. They know that if they transfer money into your bank account, they might not see it ever again. But if they transfer the money into the lawyer's account, then they have recourse because it's gone into a lawyer's account, it's gone to the solicitor's account. If, for example, something happens, they can call up the lawyer and say, right, what happened to my money? Because the lawyers are legally bound to either return money to the investors or to use it for the purpose of the reason why it was transferred in the first place. So this is sort of the steps that you are going to use when you're raising finance from investors. In a nutshell, 4 to 6 meetings. Individual investors, they're more about the story and a little bit more emotion, a little bit more about relationship and so on. They want to know the industry, they want to know the return on investment. They are normally happier investing in particular deals. Institutional investors, it's about the story, but it's more about the numbers, the return on investment. They want to know the industry, they want to know that how much capital do they need to deploy, what's the return on investment, and when they can get their money back. Less so about story, but more so about the numbers. Yes, they want to know about the numbers and their exit. So that's how you go out and you raise money from institutional investors and also private investors. And the sellers, oh, we haven't talked about sellers. So the sellers, you can tell them to roll over equity. Private equity does this all the time. So let's say, for example, you're going to buy a business, right? You're going to buy a business. You can ask them to hold 20% of the business, of the business, and you buy 80%. 80%. So you're the majority shareholder, you have control over everything, you have control over the business, you have control over the cash flows, which is the most important thing. Control of cash flows. And the seller is rolling over 20%. Now, why would a seller do that? Is because you need to tell the seller, say, look, if you keep 20% of the shares and we keep 80%, your 20% is going to be more valuable in our hands with our management because we're rolling up these businesses for argument's sake, and the sum of all of the parts is more valuable than the individual business itself. And that's why you can tell the seller to hold up 20%, 30%. Obviously, the higher amount, they start getting a little bit wary, so they want to exit, right? That's the whole reason why they're selling their business. And they can be silent investors. You can, in fact, dictate that, you know what, you can't make any decisions and you have to be a silent investor, but you're going to hold back 20%. So then you have to raise a lower amount from investors. So let's say, for example, to make the math easy, that the price of the business is 1 million. If the seller's holding back 20%, then you only need to raise 800,000. You only need to raise 800,000 because of the holdover. So these are some of the ways in which you can raise money from investors. If you want to find out more on business acquisitions, value acquisitions, increasing enterprise value, and also exits, continue watching videos on this channel, and I will see you in the next video.